Today we have an interview with Trey Reed, who is a regional manager at Cross Country Mortgage. Trey is going to go ahead and discuss a lot of different out-of-the-box loan products that will help both buyers and sellers alike. Trey, tell me a little bit about yourself.
Yeah. So I'm been in the mortgage business for 11 years now. I don't look like it, but it's true. I got some gray hairs coming in. Born and raised in Northern Virginia. I'm a father. I have 2 kids. Tommy, he's 2.5 years old. Brooks, he's 5 months. I'm a husband. My wife Alicia, we've been married for 4 years. I got in the business. It's kind of been a family business. My dad's been in the mortgage industry over 30 years, and my grandma actually started a title company in Oakton.
Oh,
gosh,
wow.
I don't know, maybe 60 years ago. So kind of been in the business, 3rd generation in the business here. So
That's awesome. I didn't know that about your grandma.
Yeah. Oakton Title and Escrow was the name of it.
People, they feel stuck in their home and they can't afford to have 2 mortgages. That's
Right.
the biggest objection. If it was easy, right? I mean, ideally they would buy the next house, move into that house, leave the house that we have to put on the market. It would be all nice, freshly cleaned, painted. Any kind of little minor renovation that needs to happen would occur. And we've got time, and we can also maybe even, overcome the seasonality of it as well, right? Depending on where they put the house on the market. But not everyone can afford to do that.
Right.
So that's why we're stuck with, okay, how do they get still have that same scenario if they've got a lot of little kids and it's hard, and pets, and it's hard to keep the house clean and organized, and they just want to be out so they're not dealing with strangers coming in the house while they're still living there. So I feel like your product would really be beneficial to allow them, if they have the income, right? They need the income, or is it they don't need the income?
Depends. So there's multiple bridge loans. So there's basically 4 scenarios.
Okay.
So there's some folks that have really strong income and they have the down payment without selling. If that's your scenario, then you're golden. Now you can buy the house and you don't need anything creative. You don't need a bridge loan. You can just do it straight up simple. Most folks either don't have the income or they don't have the cash, or both.
Okay.
So yeah, if you don't have the cash, you can do a bridge loan to tap into the equity of your current house. And now that's your down payment for the new purchase.
So how is that different than a traditional, if you're tapping into your equity?
Yeah, good question. So HELOC is going to be a home equity line of credit, is another type of loan where you can borrow your equity, and that is going to be cheaper. The downside is that most banks, if they're going to do a home equity line on your current house, you can't have your house on the market and you can't have the intention of selling. And usually you're going to take probably 20 to 45 days to close on that home equity line. Yeah. But in our market, at least when they come to me, it's, hey, Trey, I found this house. I need to put an offer in this weekend, and there's no time to close on a home equity line. So It acts like a home equity line, but the home equity lines don't just fit this scenario oftentimes.
Got you. So you mentioned if someone has the income but not enough cash, that was solution number 1.
Yep.
What if they don't have the income but they have the cash?
Yeah, so that's a more unique bridge loan that we offer, and that's my favorite product that we offer is this temporary purchase bridge loan, which folks may have not heard of before because it's very, very rare to find. But basically, if someone has 20% down, and even if they don't have the income to qualify for like regular financing to buy the new house, if you have 20% down, we'll give you a temporary loan to acquire the property, which we refer to as a purchase bridge loan.
Okay, now when you're saying that they don't qualify, you mean for their current mortgage and the new mortgage, is that correct?
Correct.
But they do have to still qualify for the new mortgage.
Yeah, once it's all said and done. So the way that we determine if you qualify is once the dust is settled and you've sold your current house and you've paid your loan balance down with the equity from sale, like once all the dust is settled, do you qualify for that end scenario? If you do, and your credit score is 700 or better, and you've got your 20% down, we'll do that bridge loan for you. It's just a logical, make sense scenario.
Awesome. And then now there's a terminology that just came to my attention a few years ago called recasting, right? Because people are like, well, I want to put all this equity that I have on property A onto my new house because I don't want to pay these huge monthly payments. And so would you explain what recasting is?
Yeah, recasting has been really popular whenever someone wants to buy house B before selling house A. Let's say you have 5% to put down on your new purchase and you've got 20% sitting in your house, but you haven't sold your house yet. You put your 5% down, you qualify, great, you're in the house, but your payment's higher than you want because you only put your 5% down. Well, when you sell your house, now you have your other 20% that I was talking about. You can apply that to your loan and recalculate your payment based on a new loan balance. That is what recasting is. It is a recalculation of the payment based on a new balance. The fee is much less than a refinance. You're talking maybe $0 to $250 payment. A refinance, you could be talking like $300, $400, $5,000.
Right.
So recast has been super popular, especially when rates are, not dramatically lower than they already have.
So it reduces the principal, it reduces your payment, it gets recalculated. What about the interest rate? Is your original interest rate intact, or does that get redone as well?
Really good question. Yeah, it's the same interest rate.
Okay.
So it's the same loan. A refinance would be it's a new loan at the new market rate plus
Okay.
more costs. A recast is it's the same loan. You're just recalculating the payment based on that new lower balance.
Great. That's awesome.
Yeah.
That's really helpful. I really feel like this is going to serve a lot of my clients and other people out there watching.
Yeah, absolutely. No, it's been super popular. In previous markets where rates are going down, recasts are less popular.
Right.
Because, I'll just refinance. I'll get the lower rate. But when rates are either stagnant or increasing, that's where recasts come into play. So we've seen it be way more popular in the last 2 years than the previous, 4.
Great. And that's an awesome solution.
Yeah, for sure.
Awesome. Okay. Now, Trey, what about getting an appraisal waiver? Like if I'm a buyer, I want to go ahead and buy this house and it's a competitive market and I want to say that I'm waiving the appraisal.
Right.
So talk to me a little bit. How does that process work? Because most people thought that all loans require an appraisal.
Right. Now you're talking about waiving the appraisal contingency, correct?
Correct.
Yeah. So a lot of buyers are concerned about waiving the appraisal contingency and they're worried if it appraises low, do I have to come up with all this extra money? Not necessarily. And I'd say most scenarios. So you mentioned appraisal waivers. There's scenarios where banks won't even require the buyer to even get an appraisal in order to do the loan. And if there's no appraisal that's occurring, you can't have a low appraisal. Therefore, you don't need to have additional cash needed or there's no additional risk.
What is the scenario that would happen where I think it goes through the automated underwriting system?
You're right.
Okay.
Yeah. So basically, a lender gets a loan application. They run it through this software. It's a Fannie Mae and Freddie Mac software, and it just spits back a thumbs up if you don't need an appraisal or not. And that when you don't need an appraisal, it's called an appraisal waiver. And there's been some recent changes. Here's the criteria. The max price is $1 million.
Okay.
So in this area, there's a lot of houses over $1 million, obviously. So you're not going to get an appraisal waiver if the sales price is over $1 million.
Okay.
And then you had to have at least 20% down in order to be eligible for one. But then the software kind of looks at the recently sold homes in the area, basically does what an appraiser would do. It's just a software. And if the sales price is within a certain range, you might be able to get an appraisal waiver. But the change that occurred is that you'll be able to get appraisal waivers if you're just doing 10% down.
Oh, that's interesting.
Yeah.
Okay.
Yeah. So it's really interesting for sure and beneficial to a buyer. And what's great is that if you're looking to submit an offer, you can check in with your lender and see if you qualify for a waiver even before you've submitted your offer. So that allows you, the agent, to write the strongest offer possible and give the buyer the best chance of getting their offer accepted.
That's awesome. And so we would just give you the address like, hey, Trey, we're about to write on this offer on this house, give you the address, the taxes, everything.
And
then
price.
Yeah, of course. And then you'd be able to just let us know, hey, you're good to go. You can do an appraisal waiver, and waive that contingency.
You can waive that contingency without having any concerns.
Okay.
Now, you're not always going to get an appraisal waiver. I'd say you're getting an appraisal waiver 40% of the time. So the
Okay.
majority of the times there's still going to be an appraisal, and that appraisal could come in low. So that's another important thing.
Right.
Like a misconception out there is that if a house appraises lower than the sales price, then the buyer has to come up with the difference in cash to make up the difference. That is rarely the case. In fact, it's only the case when the buyer has put in the minimum down payment for a given scenario. So let's say you're doing a loan and it requires 5% down.
Okay.
And you're putting 5% down. If the house appraises low, you got to come up with the difference. So let's say same scenario, but you're putting 10% down. Well, that means that the bank just wants you to have 5% equity. If you're putting 10% down, it can appraise 5% low, and you don't need to bring any additional funds to closing.
Oh, that is so helpful because that's a huge misconception out there.
Massive.
Yeah.
Yeah.
Now, would that also apply for VA loans?
So VA loans, it does apply if you are putting a down payment down.
Okay.
So oftentimes VA loans will require no money down. There's scenarios where that may not be the case depending on
Price.
the price and if they have how much VA loan entitlement they have. But the point is, most of the time, if you have a $20,000 down payment on a VA loan, it can appraise 20 grand down and low, and you can still get the same exact loan that you were looking for.
Oh, that's very helpful.
Yeah, because the VA will lend up to 100% of the appraised value most of the time.
Okay, that's great. That's
Yeah.
great. Are there any other VA loan misconceptions you think that are out there, like common questions that you get from buyers or even other agents, from listing agents?
Yeah. There's a lot of folks think that you can only have one VA loan at a time, and that's not the case. What it is, you could have, hypothetically, you could have unlimited VA loans. It's just that there's only a certain amount of total loan amount that you can have at a given point in time. And it depends on the county that you're buying in, and basically your remaining VA entitlement is what they call it. But you could have 3, 4, 5 VA loans at any given time. You just may not be able to do no money down depending on what the loan balance is on
Gotcha.
the other loans that you have.
So say if a member bought a house for $500,000 and they're wanting to buy another house, maybe, like they relocated or they just don't like their commute and they want to be closer to work. In this area, if it was Loudoun County, how much entitlement would they have left if they've already used 500?
Yeah, good question. So today, at the end of 2024, the VA loan limit is around $1,150,000. So 1.15 million. That's the total amount of VA loan you can have if you want to put no money down on your house. So for that person that bought a $500,000 house and borrowed all $500,000, their remaining loan amount they could get with no money down would be $650,000. Anything over 650, they have to put 25 cents on the dollar down.
Gotcha.
So 25% down, anything above that 650 number.
That's great. This is all great information. Well, thank you so much for letting us know this. And how can people get in touch with you?
The best way to reach out to me is probably email. My email is trey@icmtg.com or my cell phone, which we'll put somewhere.
Yeah, we'll
here.
put it in the notes.
Yeah.
Awesome. Well, thank you.
Yeah, thanks so much, Donna.